We're always told that the price of things like oil or wheat or even coffee is all about simple supply and demand. But what if that's not the whole story? What if that's not even the most important part of the story? Today, we are diving deep into the hidden mechanics of commodity markets, and I'm going to show you why the process, the actual journey a product takes, is way more powerful and, frankly, more profitable than the product itself. So let me start with a story that just perfectly sets the stage here. Picture this. An expert trader is telling his chairman that, based on all the charts, the price of soybeans is about to hit a key level and then bounce right back up. The chairman, well, he's not impressed. He picks up his phone, makes one call, and tells his team to dump all of their soybeans on the market. Right now. And just like that, boom, the price crashes. He then turns to the expert and says, "So, where did you say the market was going to stop?" His point? It was brutal, but it was crystal clear. Your textbook theories don't mean a thing when someone has that kind of raw power. And that story, it really gets to the heart of the big myth we're going to tear apart today. We all think the price of soybeans is about how many beans are grown versus how many people want to buy them. But the reality? Oh, the reality is so much more interesting. It's the market structure, the logistics of actually moving those beans, the regulations. That's what really drives the price. It's not about the beans. It's about the journey. Okay, so let's dig into this first big idea. And it's a bit of a provocative one. The market you read about online or see on the news, the one that's supposed to be this pure engine of supply and demand, well, a lot of the time, it's not really real. It doesn't reflect what's happening in the physical world. And that's the absolute key takeaway from that soybean story, right? When a single person with a single phone call can completely blow up a perfect economic forecast, it proves the market isn't some law of nature like gravity. No, it's a system. A system that's built and operated by incredibly powerful players. And if you really want to understand where prices come from, you have to stop looking at just supply and demand and start looking at who controls the process. Now, let's see how this plays out with a perfect real-world example from the biggest, most watched commodity on Earth, oil. This is where that gap between the paper market of finance and physical reality becomes so obvious you can't ignore it. Okay, first, we got to get a key term on the table. It's called backwardation. Now, I know it sounds super complicated and jargony, but I promise the idea is actually really simple. It's just when the price for a barrel of oil right now is way higher than the price for a barrel that'll be delivered, say, 6 months from now. It's the market's way of literally screaming, "I need it now, and I will pay a massive premium to get it." It's a huge flashing red light for an immediate physical shortage. And just how crazy can this get? Well, on April 7th, 2026, the extra cost, the premium for physical oil you could actually touch versus the price on a futures contract hit $35.15 per barrel. I mean, let that sink in. For the exact same product, somebody was willing to pay over $35 more just to have it in their hands today instead of waiting. And this chart just lays it out perfectly. You can see the paper market, the futures contracts, was trading around $109. But the refiners, the people who actually need physical crude to make gasoline for your car, they were in a panic. They were so desperate for immediate supply, they were paying over $144 for it. This wasn't some abstract bet on the future. This was a real-world crisis happening right now because of logistics and availability. And what's so fascinating here is what this tells us. The super high price for immediate delivery shows short-term panic. But the lower price for future delivery shows long-term confidence. The market is basically saying two things at once. We have a massive, massive problem today, but we're pretty sure we'll have it sorted out in a few months. It's just a perfect example of how the physical world and the financial world can be telling two completely different stories at the exact same time. Now, this is not just an oil story, not by a long shot. This exact same squeeze, where the process of getting a product from point A to B completely breaks down, is happening all over the place with all sorts of essential goods. These choke points in the process are causing a global domino effect. Let's talk about coffee. In just 1 month, Brazil lost out on over 173 million euros worth of trade. Now why? Was it because they didn't have enough coffee? Nope, they had plenty of coffee beans. The problem was their ports were so jammed up they physically could not get the coffee onto the ships. The product was there, the process failed. And these bottlenecks aren't always physical, like a traffic jam at a port. They can be about paperwork too. Check this out. A new EU rule is coming that will require importers to prove their coffee and cocoa didn't come from deforested areas. The supply of the actual product might be totally fine, but this new process of proving where it came from could slow trade to a crawl. It could create a completely artificial scarcity, all because of a regulatory change. And this problem goes even deeper. right into the things that build our modern world. Take sulfur. It's essential for fertilizer. 45% of the world's supply is at risk because of shipping choke points. Helium. You need that to make the chips in your phone and computer, and its supply chain is getting hit. Even aluminum. Prices shot up after strikes shut down parts of the production process. In every single one of these cases, it's a failure in the process that directly impacts price and availability. Okay, so if the producers, like those coffee farmers in Brazil, are losing money, and we, the consumers, are paying more, where is all that money going? Who's actually cashing in on all this chaos? Well, the answer is pretty simple. It's the companies that control the broken parts of the process. It's the middlemen. Just look at this. It's staggering. Before all the supply chain madness, the giant shipping companies that move stuff around the world had a tiny median profit margin, just 2.5%. Fast forward to 2022, with everything in chaos, and that margin exploded to an almost unbelievable 48%. They weren't making more things, they were just charging us all a fortune to move them. And it's the same story with fertilizer, which is absolutely critical for growing our food. The combined profit for just 9 of the major fertilizer companies jumped to over 40 billion euros in 2022. That's more than double what it was just a couple of years earlier. Why? Because they control a vital input in the food production process, and when that process gets strained, their profits just go vertical. This table just connects all the dots. It draws a straight line from the companies that control the process right to the pain we all feel in our wallets. Look here. Energy traders see their income quadruple, and European energy inflation spikes over 40%. Fertilizer profits soar, and food inflation hits almost 23%. Shipping margins go through the roof, and we see higher prices on basically everything we buy. This is the profit price spiral, clear as day. And there's actually an economic term for this. It's called supplier power. It's basically the leverage that a supplier has over its customers. So when a company controls a critical bottleneck in a global process, whether that's a shipping route, a patent on a type of fertilizer, or a trading desk, their supplier power becomes absolutely immense. And here's the kicker. This power lasts because you can't just wake up tomorrow and decide to start a new global shipping fleet. The barriers to entry are huge. This lets them basically dictate the terms and capture most of the profits. So what do we do with all this? How does this help us? Well, understanding this whole dynamic isn't just some interesting thought experiment. It actually gives us a totally new way to look at markets, a new framework for making smarter decisions. The legendary trader Richard Dennis had this amazing philosophy. He said he only trusted ideas that were universal. If a system didn't work for something financial like bonds and for something physical like soybeans, he wasn't interested. And this process over product idea, it's exactly that kind of universal principle. It applies everywhere. So here is a simple but really powerful mental model you can start using. Step 1, for any product you're looking at, map out the entire process. I mean, from the very beginning to the very end. Step 2, actively search for the bottlenecks. Where can things get clogged up? Where are the weak links? And step 3, this is the most important part, follow the power. Figure out which companies own and control those choke points, because that's where the power, and very often the profit, is going to be. And this leads to a really clear strategic takeaway. You want to focus on the sectors that own the toll roads of the global economy. Think about the shipping companies, the fertilizer producers we've been talking about. They have what's called pricing power. And on the flip side, you want to be really careful with what are called price-taking companies. Think of the farmer who grows the crops, but has no control over how they get to market. They're the ones who get squeezed every single time the costs of the process start to rise. And really, this all comes back to something you do every day. The next time you go to buy a cup of coffee, or you're filling up your car with gas, or you're at the grocery store, just pause for a second. And instead of just thinking about the product in your hand, ask yourself a different question. How much of this price is for the actual stuff, and how much am I paying for the complicated, fragile, and often wildly profitable process it took to get it to me? The answer, I think, might just change the way you look at the world.